Today, the S&P charges to yet another record high as Federal Reserve Chair Jay Powell reiterates that the economy needs continued support to fully recover. Plus, Uber and Lyft say that ride-sharing demand is back. One problem, though, most of the drivers left. And finally, we have the latest reading on where teens are spending their money and which stocks benefit the most from being Gen Z favorites. I'm MacKenzie Sigalos, and this is CNBC After Hours. The S&P 500 closes at an all-time high after a bullish day on Wall Street. All three major indices closed in positive territory as investors shrugged off some disappointing economic data. 744,000 Americans filed for first-time unemployment last week. That's a lot more than the 694,000 that economists were expecting. It's also higher than the previous week's claims, meaning that the number of Americans out of work is rising. It's worth pointing out that this data comes just after a monster jobs report from March, when the economy added more than 900,000 jobs, the biggest gain since the summer. But as these first-time claims are ticking higher, some places are actually having trouble finding workers to fill open roles. One such industry, ride-sharing. Uber and Lyft are mounting aggressive campaigns backed by significant investment dollars to lure drivers back to their platforms as user demand picks up. Deirdre Bosa explains.
So we all know that Uber and Lyft, ride sharing all over the world, was hit really hard amid the pandemic. Demand essentially fell off a cliff. But as we see an economic reopening, demand is coming back. What hasn't come back as quickly, though, are drivers. So Uber and Lyft are facing a significant driver shortage, and in response, they're offering incentives. Uber announcing a $250 million, what they're calling incentive package to bring drivers back onto the platform. Lyft is reportedly offering as much as $800 for driver referrals. So you're kind of seeing this arms race that's reminiscent of the early days for these two ride-sharing companies begin all over again, where they have to spend significant amounts of money on incentives to get drivers onto the platform to meet what they are seeing as rising demand. When ride-sharing demand fell off a cliff, you saw other spaces in the gig economy sort of take up that slack. One major place for that was food delivery, right? Uber pivoted its entire business towards food delivery. So a lot of the former ride-sharing drivers went to Uber Eats, they went to DoorDash, they went to GoPuff, right? We've really seen these delivery companies expand in a huge way. Amazon, too, has been taking a lot of drivers because there was work to be had amid the pandemic when no one was taking ride shares. So getting those drivers back onto the platform is a challenge, but some think that that's a reasonable expectation because delivery, especially food delivery, is expected to soften this year as the economy reopens, as people get vaccinated, and they want to actually sit and go out to restaurants. That's what investors will have to figure out in the months ahead. How do these substantial driver incentives, millions of dollars being spent, affect the bottom line and the path to profitability that both Uber and Lyft are constantly talking about? $250 million is a big amount. Even though Uber lost over $6 billion last year, they have told investors that they are going to reach adjusted EBITDA profitability this year. Does spending on incentives push that further out? That's a big question. And also another question, I think, is that you're offering driver incentives right now, but is this a moment where we see the battle for the rider heat up again also? Lyft could use this moment when people are coming back to the ride-sharing platforms to try and increase its market share with rider discounts. If Uber follows suit, this arms war that we saw at the beginning of the establishment of these companies, of these industries, could start all over again, and that could really complicate the profitability picture.
Okay, let's get to our sound check. Here's a roundup of the day's biggest action and what the top newsmakers and business leaders had to say on CNBC's airwaves.
The recovery, though, here remains uneven and incomplete. The burden is still falling on lower income workers. The unemployment rate in the bottom quartile is still 20%. There's still 8.5 million people out of work. And this unevenness that we're talking about is a very serious issue.
This year, next year, vaccine policy is economic policy. and it is even a higher priority than the traditional tools of fiscal and monetary policy. Why? Because without it, we cannot turn the fate of the world economy around.
Well, our ambition is to be a global marketplace for consumers of current culture. And when you look at the trends that are driving our business, we've had 100% growth from female buyers, 100% plus growth from international buyers, 75x year over year in electronics as a category, 4,000% growth in collectibles as a category. And so what we're seeing as we expand our business both internationally and across categories.
He clearly stated that he's pro-crypto, he's a pro-Bitcoin maximalist. And what I think we've got to understand is that Bitcoin is an open, decentralized protocol. Everyone in the world has an opportunity to use this, just like the internet. It's an open, decentralized protocol. And so just because other countries who may be adversarial or not to the United States are going to use it, that doesn't mean that he's taking an anti-Bitcoin stance.
Okay, so as we begin to emerge from pandemic life, forecasters are optimistic about robust economic growth. And we're seeing that play out in some consumer spending indicators. According to JP Morgan, credit card data from Chase shows spending volumes in recent weeks have been more than 10% higher than pre-pandemic levels. This behavior extends to one consumer group closely watched by Wall Street: teens. So where are they spending their money? At a whole lot of companies that are publicly traded. Lauren Thomas has the details from the newest edition of investment bank Piper Sandler's Teen Report, which was just published this week.
2 times every year, Piper Sandler surveys thousands of teens across the country and releases this survey that really shows us how much money they're spending, where they're spending that money, and what they're buying, and how else they're spending their time, be it on social media or watching content or videos online. We're seeing that teens are increasingly spending more money. They are feeling more optimistic, I think. Now, what's really driving that rebound is female teens. Female teens spending was up more so than males this time in this survey, and females are actually looking to spend more on clothing. So within the apparel space, teens still love Nike. Whether you're male or female, they love Nike. Nike has held that #1 spot for about a decade that Piper Sandler has been doing this survey. That's within both apparel and footwear. American Eagle, which also owns Aerie, came in second on this survey, and it's held that spot for a while now as well. Lululemon actually rose on the rankings this time around, kind of showing signs of more teenagers drifting toward that comfort, athleisure, leggings option, especially so during the pandemic. So Lululemon was #4. Also on the top 10 list was Urban Outfitters, Abercrombie & Fitch's Hollister division as well. More than 50% of teens claim to shop on Amazon for just about everything, from groceries to apparel to electronics. So Amazon still reigns supreme with teenagers. So what else is popular with teens? Well, they really love Crocs. And part of that is because of recent collaborations that Crocs has done with Justin Bieber. So we saw Crocs moving up on the rankings within the footwear category on this survey. Where else are teens shopping? Well, when it comes to beauty, they love e.l.f. They also love Ulta and Sephora, really popular among teens. When they're dining out, they're often choosing fast casual restaurants like Chipotle. McDonald's is really popular as well. Chick-fil-A actually had the #1 spot on the list this time around. So when teens aren't shopping online, they're spending about 12 hours per week on social media apps. Snapchat is teens' favorite app. TikTok is a close second, and Instagram is in third. But it's worth noting that TikTok actually stole some market share from both Snap and Instagram this time around on the surveys.
Okay, time for the numbers round. So let's kick it off with 30. Ahead of an antitrust trial that will begin next month, Apple plans to argue that the 30% commission it charges apps in its App Store is fair game, since competitors like Google Play have similar fees. The issue in question stems from the company's lengthy legal fight with Epic Games, best known as the maker of Fortnite. The battle began last year when Epic tried to avoid paying that 30% commission, and Apple responded by removing Fortnite from the App Store. Now, both companies filed legal documents last night, laying out their arguments. In response to Apple's defense of its 30% commission, Epic plans to argue that the iPhone maker forces apps to raise prices in order to pay that commission, which inevitably makes the product more expensive for users. Next, 9. Between the beginning and end of 2020, Instacart saw a 9% increase in the number of customers 60 and older using its grocery delivery service. That's the largest jump within any age group. The finding is part of a new Instacart survey that the company conducted to get a better understanding of how consumer behavior changed during the pandemic. According to the survey, nearly half of all Americans said that they ordered groceries online during the lockdowns. Also, with extra time on their hands, customers spent more hours preparing for holidays. So searches for items like Halloween candy, Christmas sprinkles, and plastic Easter eggs more than doubled year over year. And finally, 28. President Biden is, quote, willing to negotiate on the proposed 28% corporate tax rate included in his infrastructure plan. Biden explained that he's open to considering a lower tax rate, but reiterated that his $2 trillion package needs to be funded somehow. The president's remark comes after Republicans have criticized the infrastructure plan and the tax hike that comes with it. Even moderate Democrats like Senator Joe Manchin from West Virginia has said publicly that he prefers something closer to 25%. The corporate tax rate currently stands at 21%, where it has been since the passage of Donald Trump's 2017 tax cuts. You can dive into the debate on corporate taxes by going to CNBC.com and downloading the CNBC app. That's it for After Hours, but we'll be back here in our home office every Tuesday and Thursday, so be sure to catch us then.